Hello everyone. Welcome back to Smart Finance HQ, your hub for mastering the money game. In today's episode, we're diving into a topic that's absolutely essential for your financial journey. We'll discuss the time-tested methods used by people to achieve a free and secure financial future. By the end of this video, you'll be equipped with essential knowledge to take complete control of your finances. Let's jump right in. The significance of financial education in today's world is paramount. The faster someone begins to focus on their finances, the more comfortable they'll be moving forward. We start the process with setting well-defined financial goals. Step 1. Let's get clear on our goals. Write down what are the 3 most important goals that you can think of for the next month. Be as precise as you can. For example, a new car, saving for a house, going for a dream vacation, or becoming debt-free. Without a clear target, navigating the financial landscape becomes challenging. Once we have our goals set, we move on to budgeting. Budgeting is the cornerstone of financial success. It plays a very key role in building your financial foundation. This is where you gain control over your money. Here's a basic budgeting blueprint using average percentage guidelines. Your necessities should count for around half of your income. These include essentials like housing, utilities, groceries, and transportation. Next up, your financial goals. Dedicate around 20% to your financial goals, including paying off debt and saving for those big dreams. And lastly, we come to lifestyle choices. Reserve about 30% for discretionary spending, such as entertainment, dining out, and non-essential purchases. Remember, you can keep these percentages flexible. Adjust them to fit your circumstances and priorities. Within your budget, ensure you've set aside a portion for an emergency fund. Aim for at least 3 to 6 months' worth of expenses. Now let us plan how to manifest our goals by systematic planning and allocation of funds available to us. The most important aspect is to identify where we spend the majority of our income and how can we bring that number down. Write down all the possible scenarios below each goal to realize what stops you from achieving them and how to resolve it through sensible budgeting. Once we have these things sorted, we can move forward to tax-savvy retirement planning. Let's start this discussion by looking at Roth IRA and 401k accounts. Your keys to financial freedom. These accounts offer benefits that pave the way to a secure retirement and comfortable future. With a Roth IRA, you contribute after-tax money, meaning no immediate tax deduction. However, when you withdraw funds in retirement, both contributions and earnings are tax-free. This makes it an excellent tool for diversifying your retirement income and reducing tax liabilities. A 401k, typically offered by employers, is a powerhouse for retirement savings. You contribute pre-tax money, reducing today's taxable income. The contributions grow tax-deferred until withdrawal in retirement. Many employers also match your contributions, which basically means free money. And remember, these concepts aren't just limited to the US. Many countries offer similar tax advantage schemes. It's essential to explore options that align with your locale and contribute to your financial well-being. Next up, we have diversification of investments. This is one of the most important safety nets we can apply. It is a key strategy for building a strong portfolio. Diversifying means spreading your investments across various asset classes to manage risk and enhance returns. Here's a breakdown of common investment vehicles. 1. Stocks. Owning a stock indicates you have part ownership in that particular company. You make money as share prices appreciate and through dividends declared by the company. 2. Mutual funds. These are pools of funds managed by professionals investing in diversified stocks and bonds. 3. ETFs. This stands for Exchange Traded Fund. It is traded on exchanges and generally track a particular index. They provide diversification with lower fees. 4. Bonds. These are usually debt securities issued by governments or corporations. They provide income and are less volatile. 5. Real estate. The tried and tested model includes investing in properties for rental income and potential appreciation. This table shows us that return and risk often share an inverse relationship. Stocks that provide investors with higher returns also considered risky investments with a low safety rating. Mutual funds are considered a safer option compared to stocks since they offer diversification within the investment. Within mutual funds and ETFs, depending on the kind of fund you invest in, your investment will be split amongst different asset classes or companies. Real estate and bonds are known to provide investors with a low but safe return on their investment. They repay their investors through dividend payments, rental income as well as asset appreciation. Diversifying across these options helps you achieve a balanced and resilient portfolio. Now lastly and perhaps most importantly, we come to mastering the mindset for financial success beyond the mechanics. Let's explore the psychology of success. Mastering the mindset for financial success involves recognizing your positive and negative beliefs about money. In order to be successful, you must overcome limiting beliefs and cultivate a growth-oriented mindset. Remember, your mindset shapes your financial decisions. Make it a powerful asset. As we wrap up, remember that mastering the money game is an ongoing journey. Financial education is your passport to a brighter financial future. Armed with the insights you've gained today, you're well equipped to make confident financial decisions. These steps, if followed correctly, will be a sure path to achieving a secure and comfortable future. Thanks for tuning into Smart Finance HQ. Don't forget to like, comment, subscribe, and remember to keep learning, keep growing, and keep mastering the money game.